Let's get your week started. Live from New York City this morning. Good morning, good morning. This equity market, this NASDAQ, better than good. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Biden and McCarthy working to push through their deal. As Nvidia surges towards a $1 trillion market cap, investors begin to consider one more hike in June. We begin with the big issue. We have a deal.
It takes the threat of catastrophic default off the table, protects our hard-earned and historic economic recovery, and the agreement also represents a compromise, which means no one got everything they want. But that's the responsibility of governing. I strongly urge both chambers to pass that agreement.
We know at any time when you sit and negotiate within two parties that you got to work with both sides of the aisle. So it's not 100% of what everybody wants, but when you look, the country is going to be stronger.
And now for the hard part, gearing up for a lobbying campaign on Capitol Hill.
Just because the swamp is flawed doesn't mean the average hardworking American should take it on the chin. Why should they accept that? Sweep the COVID money, sweep the IRS money that was, to expand the IRS to go after the American people.
I haven't seen the text. I'm not a big fan of in principle or frameworks. We're all trying to wade through spend right now. At the end of the day, though, the American people have to understand that we are at the brink of default. We don't have a deal yet.
So as expected, some Republicans aren't happy, some Democrats aren't happy. And even though time is short and the Treasury cash balance is below $40 billion, the president is still feeling good.
I never say I'm confident what the Congress is going to do, but I feel very good about it. I've spoken to a number of the members. I spoke to McConnell. I spoke to a whole bunch of people, and it feels good.
If that good feeling is warranted, if this deal passes, it would suspend the debt ceiling until 2025 and cap federal spending for the next 2 years. Goldman Sachs calling it a major reduction in uncertainty, a minor reduction in spending. They say the spending deal looks likely to reduce spending by 0.1 to 0.2% of GDP year on year in 2024 and 2025. Let's get to the Bloomberg team. AMH down in Washington, D.C. alongside Katie Lyons. Anne-Marie, how difficult is the next few days going to be?
Yeah, John, it's going to be difficult. Landing the deal is one thing, and they were able to do that over the weekend between the president and McCarthy really being the final negotiators at the table. And then, of course, getting it through the House and the Senate is a completely different story because both these men are dealing with the far right and the far left of their parties. Today, there'll be one crucial step forward and a test, really. It has to first go to the Rules Committee. There are 3 hard right conservatives that are very critical of McCarthy on this committee. So today, we'll even know whether or not this bill will make it on the floor. But if it does, it would set up a vote for tomorrow. And if we have a vote tomorrow, with both camps really calling the centrists within their party, making sure they can get this over the finish line, we would likely see that happen. Then it goes to the Senate. And the Senate, even though you have the president saying he's spoken to Mitch McConnell and he feels like he can get the votes, what you could have is a very long, drawn-out, cumbersome process because already you have senators like Mike Lee of Utah who say it doesn't go deep enough in the spending cuts, and then others like Lindsey Graham who wants to see amendments for higher defense spending because they don't think 3% is enough when you start to factor in inflation. So while there is a path to get this done by June 5th, there could potentially be some drama.
Kaylee, is time against us?
Well, the clock certainly isn't in anyone's favor here because we're now less than a week out from June 5th, which, as Anne-Marie was just alluding to, does provide some challenges because there isn't much room for error, and yet there is room for error in Congress. And we have to keep in mind as well that it isn't ultimately just about getting to June 5th. It's whether the ratings agencies decide that we're too close to the brink, because, of course, we had Fitch putting the U.S.'s credit rating on negative watch last week. We all know what happened in 2011, where we hadn't even hit the X date yet, and the U.S. was downgraded. So certainly there are risks here. We also have to consider the risk for the market of the deal actually making it through Congress, passing. The president putting the signature on it, raising the debt ceiling in time. What that means, though, John, is that the Treasury is then free to borrow and will need to borrow a ton in order to rebuild its coffers. We're talking estimates of $1 trillion in issuance by the end of the third quarter, and that could really create a liquidity drain for this market and ultimately weigh on risk assets, even if there is a deal in the first place.
Let's have that conversation right now. Kelly Lyons, Anne-Marie, to the two of you down in Washington. Fantastic work through the weekend covering this deal as it came through. Joining us now is Crossmark's Victoria Fernandez, Morgan Stanley's Andrew Sliman. Let's pick up on that point from Katie, Victoria. Let's pick up on that point. Maybe up to $1 trillion of T-bill issuance coming up over the next couple of quarters. I don't know what the number's going to be. Is that something I should worry about?
Well, Jonathan, I think it depends on how that's going to be funded, right? We say 1.1 trillion are the numbers that I'm seeing by the end of the third quarter when we start to do the budget deal. If we get the money coming out of the reverse repos, then it's just kind of a shift on the balance sheet, and it's not going to be affecting liquidity. And I think that's the key thing we need to be watching here is what's going to happen to the liquidity in the market, because that's been the base that's been supporting the market for the last 6-9 months. If we see money coming out of reserves, then that's a little bit of a different story, and I think we have to be concerned as to what happens there. So I think we have to dig down a little bit deeper than just the amount that's being issued, and also realize what that's going to do to debt coverage, because we're issuing at much higher rates than what we've done before, and it's a tremendous amount. So I think there's a lot of issues to deal with. We look at 2011, everyone likes to compare it to then. Once we got the deal, there was actually more austerity in that deal than what people anticipated, so the market pulled back. I don't think we're going to get that same reaction this time based on what we're seeing in this deal. There doesn't seem to be as much austerity, but the liquidity component, I think, is key. That could drive some more volatility for this market.
Well, let's unpack those two issues and start with the growth story. Andrew, is any of this meaningful enough to be a drag on growth anytime soon?
Certainly, I think higher yields continue to stress the banks. And to the extent that, as Victoria said, there's more liquidity, there's more issuance coming, or higher rates, it only will further tighten financial conditions. So I think that's the point of stress in the system right now.
Let's pick up on that point. Victoria, you alluded to it. Are banks going to be competing with the T-bill issuance of the next couple of quarters if indeed we assume this passes?
I'm not sure how they can avoid it. I mean, this story that we've had over the last 2 months or so has been about banks having to raise those rates. If we see all of this issuance come out, it's a very easy process for people to shift those funds into buying T-bills. I mean, we did it for our clients last week. We had clients calling us saying, hey, we're moving some cash over to you. We want short-term treasury bills to capture that 5% plus yield that we're seeing because we're not getting it at the bank. So it's already starting to happen. Does that continue? It could. So what does that mean for banks? Well, they've had a tough time since the banking crisis started back in March, but I think they can level that off a little bit, raise rates a little bit. Yes, it hurts their margins, but I think they're going to have no other choice but to do that.
If we can park this and refocus on the data, payrolls on Friday, June 13th CPI, June 14th the Fed decision. Victoria, I've got Andrew Honhorst over at Citi setting the bar pretty low. He says 200,000 new jobs out this week, another 0.4% month-on-month core CPI read. He says this Fed's going to hike in June. Are you on the same side as that?
I don't think I can disagree with them from where we sit right now. Look at Fed Fund futures. I mean, you've got a 67% probability that we're going to have a 25 basis point rate hike in June. Last week, that was at 20% chance. So it's been a huge shift because we're not seeing inflation come down at the rate that the Fed wants to see. Now, if you tell me JOLTS numbers comes down, if you tell me we get more people coming into the labor force and we're starting to see some cracks within the labor market, then perhaps the Fed says, all right, we're going to pause a little bit. But monthly CPI continues to hold strong. You look at the weekly economic indicators coming out of the New York Fed, they're holding steady. We're not seeing that decline like the Fed is wanting to see. So I don't think we rule out a 25 basis point hike in June, although I think the other thing that we might see is a skip, not a permanent pause, but a skip there, and then maybe reassess in July. I think those are going to be your two options.
At the start of the year, people were itching to buy T-bills, whatever. And if I promised you 5% for the rest of the year, a lot of people would have taken it. It looked good. Cash wasn't trash anymore. It gave you 5%. Then, Andrew, Meta happened. Nvidia happened. The NASDAQ happened. Andrew, this great quote from you and our colleagues here at Bloomberg in the last week, and want to share it with our audience who might not have read it. If I were a financial advisor and it gets to October, November, and I haven't made money for my clients because I'm heavily in cash, I would start to get nervous. Andrew, do you think they're getting nervous right now?
No, I think it's too early for two reasons. Number one is it's too early. We still have to get through the summer. It's always a rocky time for equities. And the stock market's up single digits. So single digit stock market versus 5% or whatever risk-free, is not compelling enough. I think it's when you start to get returns where if the market breaks above a double-digit return and you're still sitting around waiting for that big pullback that so many strategists have predicted, that's when the nervousness sets in. I just think there's a high level of fear, and it's only a question of when does fear pivot to FOMO, and you're seeing markets move higher. People are generating returns in stocks versus sitting in cash.
I can see that fear right now in Nvidia, the fear of missing out.
Yeah.
Andrew,
Yeah,
that
absolutely.
name right now, 406. The line in the sand is 404.86. That's the $1 trillion market cap line in the sand. Victoria, how deep is the FOMO right now, looking at that name on the screen?
It's pretty deep, Jonathan. I mean, we had clients call us last week saying, do we need to switch and be more growth oriented in our large cap strategies where we have more of a core focus right now because of exactly that. They do have a fear that they're missing out on some of those elements, but we have to talk to people and go, look, we've got to look at balance sheets. We've got to look at valuations. We know there's this element here. We have exposure, but do you want to overweight to a stock that's trading 175 times forward earnings? It's a little scary to do that, I will admit, as a portfolio manager. So I think you have to balance that. You have to have some exposure for your clients there, but I also think you have to talk to them about valuations and what it means to have a more diversified portfolio and have some of those more defensive stocks, because quality is the factor that's leading overall right now with such narrow breadth in this market, and you can't ignore that.
What a run. We'll continue the coverage. That stock up by more than 4%. Victoria, Andrew, sticking with us. Equity futures going into the opening bell about 20 minutes away. Futures positive by 0.5% with some movers. Here's Abby.
You gave the number, John, and it is 404.86 on Nvidia, above that, and we are above that level right now in the pre-market. Means $1 trillion achieved for a chip maker, the first time that this will happen, potentially likely to happen, and that comes on that blowout quarter and the massive enthusiasm, the mania for AI. It's also helping out Palantir Technologies. Take a look at that stock soaring, up 7%, another AI play. And Kathy Woods is saying that Tesla is an AI play. Christian Fromhertz of Tribeca Trade Group told us this last week as well. That stock up 4%, and we've just even had a headline, John, that CrowdStrike is now announcing introing AI-powered security. If you have those two letters, your stock is higher.
Of course, why not? Just throw out AI and see if it sticks. Abby, thank you. Coming up, Nvidia continuing to fuel the AI frenzy.
Every 2 years, we take giant leaps forward, and I'm expecting the next leap to be giant as well.
Nvidia looking to become the world's first chip maker with a $1 trillion market cap. That conversation up next.
Every 2 years, we take giant leaps forward, and I'm expecting the next leap to be giant as well. This is the new computer industry. Software is no longer programmed just by computer engineers. Software is programmed by computer engineers working with AI supercomputers. These AI supercomputers are a new type of factory.
It's the hottest stock in big tech. It is arguably the hottest stock in the world. Nvidia rallying ahead of the opening bell, poised to become the world's first chip maker with a $1 trillion market cap. This coming after unveiling a batch of new AI-related products in Taiwan. The company's CEO feeding the frenzy, saying all the right things, telling graduates during a commencement speech, quote, agile companies will take advantage of AI and boost their positions. Other companies will perish. Adding, quote, in every way, this is the rebirth of the computer industry. Alex Webb joins us now for more. Morning, Alex. Quite a speech from that man.
Absolutely, and it was really interesting actually when you look at the industries that he was willing to talk about. He was talking about the gaming industry, obviously very significant in its own right, but he also talked about this partnership with WPP, that's the world's biggest advertising agency, and the way that AI capabilities can be used to make personalized videos, huge, like loads of different iterations of videos for a given product. Now, don't forget, advertising is the business that underpins Google and Facebook, so the biggest tech companies of the past decade or so. It's sort of saying that we are going to be taking a chunk of this massive industry that has underpinned the last tech surge. He's making a very compelling case for the long tail that AI is going to provide Nvidia. He's sort of trying to provide justification for this, very pricey stock price right now by showing the long tail that he sees.
Alex, it's funny you mentioned WPP because some people are trying to work out how much of this is marketing and how much of this is real.
Look, I think that we are seeing a lot of people, as Abigail was saying just before the break, a lot of people throwing AI into their public statements right now to try and bid up the share price. The thing is, we're seeing AI already. This isn't just stuff that we've seen with ChatGPT. AI has huge applications that aren't necessarily quite as consumer-facing. ChatGPT really brought it to the public's attention. Now everybody's sort of saying, well, hang on a sec, look, we're doing this already. We don't quite know the extent to which Nvidia is going to be able to dominate that market. I don't think there's really a question that the market exists and that there will be a huge number of AI applications in the years ahead. The question is what chunk of it, the size of the chunk that Nvidia is able to take. Nvidia will have you think that basically they're going to be getting the lion's share. The reality might be a little bit more nuanced, and that's when the sort of pricing question starts to become a little bit harder to answer.
Alex, thank you, mate. We'll catch up with you around the opening bell, I'm sure. That stock right now, 406. The number, the line in the sand, 404. 86. That's your $1 trillion market cap watch going into the opening bell. Victoria Fernandez, Andrew Sliman back with us. Victoria, I'll build on the question I asked Alex. How much of this is hyperbolic nonsense and how much of it is just an unavoidable trend that you need to get a part of and get a part of quickly?
I wish I knew the answer to that, Jonathan, but you think of like the word count. I don't know how many times AI was mentioned during the earnings season, but it was some astronomical amount and everyone is latching onto it. And you have to kind of wonder, is it similar to what we saw in the EV space, right? Where you had Tesla come out and they were the main driver and they still are, but you started to see everyone else try to catch up to them. Is that what we're going to see with Nvidia? I don't know. It seems like maybe we're in that position right now, but I have to tell you, this whole thing really scares me. I wonder, maybe I show my age when I say, do people not watch the movie The Terminator and understand what all is going on here? And I think we need to be very cautious going forward and really look at what kind of regulation goes around this and what that's going to mean for the growth of AI going forward. I just think there's so many unanswered questions. I don't think you put all your eggs in the AI basket, but you have to have exposure knowing that it's going to be part of the future.
What you just said just reminded me of that line from Michael Hartnett of Bank of America going into the weekend. If you're going to lose your job and be replaced by AI in the next few years, you might as well own some AI as a hedge. No. Andrew, I think a lot of people might be on that page right now. Andrew, I've heard people look for a rotation away from the winners, a change of leadership in this equity market. Where's that change in leadership going to come from with these things developing on the screen?
Yeah, well, look, first of all, one thing I would point out is, yeah, we're very focused on stocks like Nvidia right now, but, 90 of the 500 stocks in the S&P are at 52-week highs. That's 20% of the S&P. So there are a lot, and it's not just all tech, healthcare, industrials. So I think energy is the only area that doesn't have a stock 52-week high. So there's a lot of ways to generate return in equities without just chasing what we're all focused on today. The other thing I would point out is some of these chip companies and semi-equipment companies are still relatively cheap, I think, and clearly they will participate. So there are ways to play the AI without just chasing Nvidia. In terms of the broadening out, look, I think a debt deal to pivot here. Whenever the days when it looked like we were moving forward, the breadth was better. When in days like we were moving backwards, the breadth wasn't as good. So I think a debt deal would help areas like industrials, materials, some of the more cyclical areas. I could see a little bit of a rally in those areas because because they are so oversold relative to tech.
Andrew, if I'm in the index right now, at the index level, in the S&P 500, like so many people are, is bad breadth, narrow breadth, bad news?
Well, that's a great question, Jonathan, because that's the argument amongst the bears, is that bad breadth is, a sign that we're on the precipice like the year 2000. And it is true that we had very bad breadth in 2000 before the market collapsed. However, when you look at the data, there's no conclusive proof that actually bad breadth doesn't lead to always a sell-off. Many times it leads to broadening breadth in the market rally. I think that will happen. I'm just not sure, other than short term on a debt deal, I'm not sure that will happen until we get past Labor Day.
Victoria, final word, please.
Well, I just think people need to be a little bit cautious here. Yes, just because we have a lack of breadth in the market does not mean that the market can't go higher. It can when we have the momentum and the sentiment that we're seeing, especially around the AI stocks. But I think we have to be careful if we're looking at a sustainable bull market. A lack of breadth makes that hard to happen, especially as we go into the later part of this year, where we're working through 500 basis points of rate hikes, a potential another rate hike, the consumer slowing down, earnings probably coming down. I think you have to position yourself with a little bit of defense in your portfolio in order to buffer some of the volatility that I think we'll see as the markets pull back in the end of this year.
The Nasdaq up more than 30% year to date. Right now, at more than 1%. Victoria, Andrew, to the two of you, thank you. Your equity market about 7 minutes out from the opening bell, positive on the S&P 500 by 0.5%. Coming up in the morning calls in later, Clear Harbour's Aaron Cannon joining us at the opening bell to discuss the narrow breadth in this equity market and a record-breaking stock, Nvidia, adding hundreds and hundreds of billions of market cap in just a few weeks. This is Bloomberg. Equities up big time on the Nasdaq. You can thank Nvidia for that. On the S&P 500 up by about 0.5%. That's the price action. Here's some morning calls. First up, Jefferies upgrading Ford to a buy. $16 price target, seeing signs of improving execution during the automaker's investor event. Roth MKM upgrading Constellation Brands to a buy, expecting beer sales to start accelerating during the summer months. That stock is up by 0.8%. And finally, Atlantic Equities upgrading Coinbase to overweight, recommending investors shrug off the near-term risks with longer-term opportunities piling up. That stock is up by another 4.5%. Coming up, Nvidia charging towards a $1 trillion market cap. The AI rush fueling another day of big tech outperformance. That conversation up next with Clear Harbour's Aaron Cannon. Your opening bell just around the corner. Two-day winning streak on the S&P about to become 3 at the opening bell. Equity futures right now up by 0.5%. On the Nasdaq 100, 5 weeks of gains. We had some more weights at a rally around the open. The Nasdaq 100 up by 1.25%. One stock to watch, Nvidia. We'll get it to Nvidia at the opening bell. There is your open. Switch at the board and get to the bond market. Yields look like this, down about 6 basis points. Your 10-year, 374. A touch of dollar weakness out there, some euro strength. Euro dollar 107.34. That's after breaking 107 a little bit early this morning. Briefly, a 106 handle. That currency pair now positive by 0.2%. And crude just about holding on to $70 and about 20 cents. Call it 30. We're down by more than 3%. We are about 25 seconds into the session. Equities up by 0.5% on the Nasdaq, by more than that. With the one stock to watch at the open, Nvidia rallying after unveiling a batch of new AI-related products. 404.86 is the level to watch. And Abby, we've got through that level right now.
Indeed. $1 trillion, the first chip maker to achieve that level. And for moments there, we went back below that 404.86. But right now, the stock up well above that level, up above that key $1 trillion mark by almost $2, having to do with those new AI products that you were talking about, along with that blowout outlook, more than 50% above what the street had been estimating. And it just anything AI, this mania that we have, is driving this stock higher. But Victoria Fernandez made a great point when she was talking to you just moments ago. The valuation, it's crazy high on other metrics. EV to EBITDA, 31% above the group. Revenue to enterprise value, I believe it's like 13% above. So how long will this parabolic trend, up 30% over the last couple of days, last? It's unclear whether or not that will happen. But there is that $1 trillion mark for Nvidia. And right now, this mania, it really has some takers, John. It's going to be interesting and fun to watch.
Phenomenal. That's a melt up in market cap. Just amazing. Nvidia up by another 4%. We'll return to that name in just a moment. I want to turn to Tesla just briefly. Shares up this morning by about 3%, just short of 200. Elon Musk meeting with China's foreign minister early today. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Shares up about 3%, as you say. The meeting with Qinggang took place in Beijing. In a statement issued by the Chinese government, Elon Musk is quoted as saying that Tesla is against a decoupling of the relationship with China and will continue to expand its business in that region. Qinggang, the foreign minister, also saying in the context of US-Chinese relations that it's important to get the steering wheel right, he said, and step on the brakes in time to avoid dangerous driving in the context of that relationship. Important because, as Dan Ives of Wedbush puts in his note, Jonathan, it's a good opportunity in the first instance for Tesla to take more market share of domestic sales relative to domestic peers in the EV space. It produces a lot of vehicles out of Shanghai, but doesn't sell proportionately as many of those in that domestic market. But of course, as well, an expansion of Shanghai is underway. As Bloomberg reported, according to sources, a new generation Model 3 is nearing the trial phase of production in that plant. So critical market for production, but as Dan Ives of Wedbush notes, a key opportunity to expand domestic sales as well.
Just out of interest, Elon Musk has been very open about his willingness to express his political views here in the United States, even if it costs him. Now, I just wonder whether the same applies to China.
Yeah, I think what's interesting to note is that this is Elon Musk's first known visit to that nation, to China, since before the global pandemic. They've continued to invest and expand their operations in that Shanghai plant. They are a large employer there. There have been tensions relating to issues of security, for example, around the camera and data sensitivity around camera imagery taken from the Tesla vehicles. But it's an area that continues to be important. And again, go back to the earnings call transcript and look at how many times the word China comes up.
Stock is up 4%. Ed, we'll touch base with you again in about 10 minutes' time. Elon Musk in China. Jamie Dimon heading to China as well. We're going to catch up with Jamie Dimon a little bit later on this evening on Bloomberg TV. So look out for that conversation. I want to turn to crypto-related stocks as well. Getting a boost as Bitcoin climbs for a 6th consecutive session. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, it's hard to know with crypto. This could be a relief rally coming off of that weekend debt ceiling related news. It could be a knock-on of the AI boom. We know that crypto and tech stocks tend to trade hand in hand. But no matter the cause, the takeaway here today is that these crypto stocks are definitely rallying. If you take a look at Marathon and Riot, those are both Bitcoin miners really seeing a pop this morning. You can see that Riot there down at the bottom, up over 10%, as is Coinbase, really seeing a pop this morning. It was upgraded to an overweight at Atlantic Equities. Of course, Coinbase is one of the biggest crypto exchanges out there. And you see SoFi rallying as well. That could be more again about the debt ceiling. BTIG did say that the resumption of student loan payments should help that company. But what's interesting here, John, is that the rally that you're seeing in the stocks is greater than Bitcoin itself. Again, you can see Riot there up almost 11% at this moment. Bitcoin up less than 1%.
Katie, thank you. Big run there year to date for some of the crypto-related themes. Here's another one. Just looking at the Bloomberg right now, Nvidia, $1 trillion market cap. Just today alone, we've added an extra $40 billion to the market cap of this company. We are up by about 3.6% right now, just pulling back from that $1 trillion line in the sand. AI-related stocks gaining across the board, though. Microsoft up just a little. Meta has been a standout year to date as well. Let's get back to Alex Webb for more on some of this. Hey, Alex.
Hi, Jonathan. Yeah, it's really a kind of blockbuster number they've finally been hitting. Interestingly, this is very much a pure play hardware company, deep tech. The other companies in this bracket are the Amazons, the Microsofts, the Apples of the world, all of whom have got a slightly different proposition. This is a cliche that has been invoked heavily over the past few days. It is the picks for the gold rush, but the crucial thing with Nvidia is they have the picks today. They have them, they're able to sell them. That means that when the demand was there, they were able to deliver on it almost immediately. There are going to be other winners in this space. The question is whether they have the availability right now in the way that Nvidia does, and that's clearly one of the reasons that we're seeing such stellar numbers for them right now. 6 minutes into the session, that stock's up by close to 4%. The broader market on the S&P 500 up by 0.5%. The Nasdaq up by more than 1%. Alex Webb, thank you. The run continues. Big tech continuing its big outperformance and grabbing the attention of Wall Street. Deutsche Bank's Jim Reed going into the weekend saying this continued tech frenzy has caused the narrowest rally of the century. The S&P 500 now outperforming its equal-weighted index by the most since 1998. Citi Stuart Kaiser noting stocks can continue to rally. He said, quote, not all periods of large-cap leadership end poorly. There are 10 previous episodes when cap-weighted SPX beat equal weight by at least 300 basis points in a 3-month trading window. Markets were up in 5 of 11 cases and rose over the subsequent 3 months in 6 out of 10. Let's have this discussion right now with Aaron Cannon of Clear Harbor Asset Management. Aaron, great to catch up with you, sir. We've got to build on some of these big gains. And I guess the question at the moment, does this narrow leadership really matter? If I'm at the index level right now, hugging the gains, do I care?
Well, we work in the world of probabilities, Jonathan. And I think that, if you look over the course of history, narrow breadth tends to be problematic. And there are a couple of exceptions to that are worth noting in 88, 89, 94, 95. But since 1929, when breadth is as narrow as it has been recently, when I say narrow, we're talking about 7 stocks, 54% of the NASDAQ 100, 7 stocks, 27% of the S&P 500. And you look at the returns of the 493 stocks not represented, they're only up a little less than 1% year to date. And the S&P is up over 10%. Large cap, too, is up almost 10%. Small cap, looking through the prism of the Russell 2000, down less than 1%. So the breadth has been truly problematic for this market.
So when people start talking about setting up potentially for another period of U.S. exceptionalism, U.S. equity market exceptionalism after the last 10 years of FANG, are you pushing back against the idea we can do the same thing with AI?
Well, I think it's remarkable, and I still believe that if you look at Nvidia, it's a wonderful case study in American ingenuity, in American exceptionalism from a technological perspective. And I think that we do have the brains, in the know-how, in the funding to continue to create these companies to add value to the overall economy and increase productivity as well. But it's also the case that we could be entering a period of economic deceleration. It appears as though that's what's happening, and maybe employment has peaked. And so I don't think it's a conflict of thinking that perhaps we continue to see slower growth here going forward. We could see some pressure on the equity markets going forward if this breadth finally falls by the wayside and we start to see a real correction in the market. But that companies will continue to wade through difficult times, capture market share. Those that are well managed, have great technologies, wide moats, certainly will prosper over time.
And you've mentioned that weaker growth, those disinflationary trends that you and I have talked about continuously over the last several months together. Whenever you've come on, you've always talked about that. And at the same time, I've had yields higher over the previous 11 days, not including today. I'm talking about pricing out rate cuts and pricing in rate hikes. Yields up, and it hasn't hurt the equity market story. Aaron, what do you make of that?
Well, I think part of it is just that this breadth effect. It has, for the vast majority of the equity market, been a point of pressure. But you are right. You look at the 10-year Treasury yield; it's up about 15 basis points year to date, and been marching higher over the last 2 weeks. Two-year Treasury yields as well. We've gone from sort of Fed rate cut mantra for the next couple of months to, well, we may even have another couple of hikes here in June and maybe even in July. So certainly, points of concern here in the underlying market.
A lot of speculation. Go on, Aaron, complete your thought.
No, I was just sort of thinking too, at the end of the day too, we are seeing further evidence of inflation deceleration. I think the notion that we've gone from 9% inflation headline to 5% inflation headline, and it's going to be difficult to move from 5 to 2, and maybe that's the indigestion that many sort of bears in the market, and I don't consider myself a bear, far from it. I think in the short term, again, it's about probabilities. I'm concerned. I think in the long term, the equity market must outperform the bond market over a multi-year period, or else we're all in trouble here when you think about just sort of the capital stack in corporate America and around the world.
With that in mind then, given what you've just said, for anyone who's been sat in cash through much of this year, and they've been rewarded for that, given what the yields are at the moment, I can pick up 5%, hide, not pay attention to any of this. If you were allocating new capital today, Aaron, in this equity market, where would it go?
Yeah, I think you want to respect the rally on the one hand, which is contradicting perhaps my concern about breadth. And so, owning broad market is okay. And owning broad market ultimately means that the future winners in the market will accrue. And that's in a market cap weighted index. But I also think there are wonderful opportunities outside of the three sectors that have rallied year to date. And we know why those three sectors have rallied. You look at communication services, you look at consumer discretionary, you look at tech, and then you go back to those 7 names that we just mentioned before. That's why those sectors are up year to date. But there are some wonderful industrial companies that are, on the cutting edge of increasing productivity on the manufacturing floor. You look at the utility segment, everyone's looking at, electric utilities. How about natural gas distribution utilities? How about the water utilities? Lots of interesting ROE growth opportunities here and into the futures as municipalities say, you know what, we don't want to manage our water systems. We would rather outsource that to companies that are experts that only do this for a living and have done it very well. So, there are lots of opportunities in this market that we're very excited about. But we think about valuation and we think about the duration. How much time do each one of our investors have as it pertains to these investments? And we craft our asset allocations around that client. And that's what we're doing here at Clear Harbor.
One quick final question from me, one last question. 12 months ago, in the summer of 2022, if we had these kinds of equity market gains, Aaron, and I said if this was a problem for the Fed, overwhelmingly, I think a consensus view would have been it's a problem for the Fed. They need to get financial conditions tighter. They need to get inflation down. Has that view changed 12 months later?
No, I think the Fed, they got into the game late, and I understand why. They thought that it was going to be transitory in a very short duration perspective, and now they do not want to be accused of taking their foot off the gas pedal. And I think that's a real predicament for the Fed, and we understand why that is. But there are incipient reasons to believe that employment is starting to, you look at the JOLTS data, you look at some of the temporary companies that are in the business of hiring, things are softening there. We're at a historical low unemployment, but we're also seeing a lot of the, sort of supply chain woes trending through. And we understand that, at the end of the day, when you raise rates over 500 basis points, it's going to have an effect, but it's going to have an effect with a lag. And the Fed's aware of that. And the timing of all of this is uncertain. We believe at the end of the day that the Fed raises rates 1 or 2 more times and pauses, and then we eventually see cuts as the likelihood of a recession over the next 12 months becomes a little more obvious on the heels of weaker growth and weaker employment.
Aaron Cannon, a Clear Harbor. Aaron, always great to catch up with you, sir. Thank you. About 14 minutes into the session. Here's the name to watch right now. Nvidia near session highs. Session's young, I know, 15 minutes into this session, but still up 6%, this name at the moment. A $1 trillion market cap, up more than 6%. Now, typically, I don't care about the round number stuff. Tom and I were talking about this earlier this morning on Bloomberg Surveillance. It's the manner at which we got there. The fact that we've added hundreds of billions of market cap in like several weeks. In fact, one session we did that last week. It's just been absolutely phenomenal. That name up more than 6%. Coming up, from Musk to Diamond, corporate America making their way to China.
Things will get better again. China didn't use massive stimulus or this paycheck program. We see some bumps here, but we think the overall journey to recovery is on track.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Cummins President and CEO Jennifer Rumsey. That conversation at 2:30 p.m. Eastern, 7:30 p.m. in London. This is Bloomberg.
I would say recent April-May data weakness as a hiccup. Things will get better again. China didn't use massive stimulus or this paycheck program to jumpstart the recovery. So like other Asian economies, without that massive transfer program, you need time. So it's not a surprise we see some bumps here, but we think the overall journey to recovery is on track.
Corporate America continuing its push into Beijing. The Tesla CEO Elon Musk meeting with government officials in hopes of maintaining ties with China. Wedbush's Dan Ives saying the visit comes at a key time, writing playing nice in the sandbox in Beijing is something the street is laser focused on to make sure there's no disruptions to Tesla's expansion. This is JP Morgan CEO Jamie Dimon brings his China summit back to China for the first time since 2019. Let's get to the team coverage. Ed Ludlow and Sonali Basak join us right now. Ed, let's go to you first. Elon Musk already there.
Yeah, Elon Musk already there. First visit since before the pandemic. And, you know, the key development was his meeting with China's foreign minister, Qin Gang. You know, the ministry issued a statement which quoted Elon Musk as saying that Tesla is against a decoupling from China and that it will continue to grow in that nation. But it's kind of consistent with corporate America. Tim Cook visiting Apple in March, reiterating its importance strategically for the iPhone maker. Mary Barra, the CEO of General Motors, kind of talking about the need to work with local partners in China, it being a key market for clean energy vehicles. There is this growing narrative that contrasts corporate America's view of China with that of President Biden in this nation. The action of sanctions, for example, hitting Nvidia's ability to export its latest chips to China. And not just here in the US, but in continental Europe as well. You look at what the Germans and Olaf Scholz have done, or the Dutch in joining with US chip sanctions against China. There is this contrast between the corporate narrative on the importance of that market and what political leaders are telling us.
Sonali, Jamie Dimon's turn. Up next.
It sure is, and this is a massive conference. We're talking about 2,600 people that are going, companies, investors. Remember, this is not only from China, this is also large corporations from the United States also going. Executive CEO from the likes of Pfizer, Starbucks, while Morgan Stanley over in Hong Kong also has another conference with another 1,500 investors. So this is an insanely important market. Remember, not just for the companies themselves with an expectation of the market reopening, the consumer coming back potentially a little bit stronger here, but also this idea that there is wealth, serious wealth, John, accumulating in China, and these are big clients. These are big private net worth, high net worth clients at a time where JP Morgan, Goldman, Citigroup, all are big in China and growing those businesses to gain some greater returns at a time when their other businesses have been under pressure.
Sonali, is that still the place they want to be, or has that changed in any way, shape or form over the last couple of years?
Listen, anybody that was in China to begin with knew that it would be a slow, steady burn, that there would be fits and starts. And so if you've made the commitment and if you're operating at scale, you're not backing away. Though if you are not at scale and you are a smaller fund manager in the region, you are probably not sticking around for the economics less than the geopolitics. But the big banks, they are certainly committed to China, and there's no sense of them pulling back.
Looking forward to our conversation with the man himself, Jamie Dimon, coming up a little bit later on this evening, I believe 11:30 Eastern time, that taking place over in Shanghai. Sonali, thank you, alongside Ed Ludlow. For the broader price action, about 22 minutes into this, we're up by 0.3% on the S&P. The gains fade a little bit on the Nasdaq, up by 0.8, call it 0.9% into positive territory with some sector price action. Here's Abby.
It's interesting, John, because we do, of course, have this gain for the S&P 500 and this feeling of a big rally because of Nvidia, but we have more sectors trading lower, led by energy. We have a quiet sell-off, I would say, for crude oil, down 3.6%, just holding on to $70 a barrel. On the other hand, we do have tech sharply higher, up 1.6%, driven by Nvidia and the chips and anything related to AI. Let's take a look at these stocks in this index over the last week, because it is a big rally. The stocks last week putting up its best week going back to November of last year. There's Nvidia over the last 5 days, up 36%, an absolute melt up, as you said before. Parabolic. The question is, will these gains last, John?
Abby, will they stick? Have to bear in mind it's only May, so when we talk about year to date, we're not even halfway through the year and we've got gains of more than 100% on that name and on Meta as well. Coming up, your trading diary. Going into payrolls Friday. Up next. "26 minutes into the session, advancing by 0.3% on the S&P. Day 3 of gains on the S&P. On the Nasdaq, up by about 0.7. The gains fade just a touch. That's the price action. Here's the trading diary. Coming up through the week, U.S. consumer confidence numbers at the top of the hour. Richmond Fed President Thomas Barkin speaking at 1 p.m. Eastern Time. We get the Fed's Beige Book on Wednesday. More Fed speak before the quiet period. Collins, Bowman, Harker, Jefferson, all on the agenda. And before we get to payrolls on Friday, ISM manufacturing, the ADP report, jobless claims, then the big one, payrolls, the estimate, 190K. From New York, that is it for me. Thank you for watching Bloomberg TV. This is Bloomberg.